In the world of options trading, there are numerous strategies one can employ to strive for profit. Among them, the Iron Condor stands out as a popular choice for traders seeking to generate income with a controlled risk approach. Named somewhat whimsically, the Iron Condor strategy is beloved for its ability to provide potential profits in a market that is moving sideways. Essentially, it is a strategy that allows traders to profit from the lack of movement in the market. The Iron Condor is structured in such a way that it capitalizes on the time decay of options, aiming to enable traders to collect premium income over time. This setup is particularly appealing for those who prefer a more passive income approach through options trading. By using this strategy, traders can potentially create a monthly income stream, assuming market conditions are favorable. Understanding the Iron Condor, however, requires a grasp of several key concepts of options trading, including the use of call and put options and the significance of strike prices. Let's delve deeper into the components and workings of this intriguing strategy. An Iron Condor is a type of options strategy that involves 4 different options contracts. It is constructed using 2 call options and 2 put options with different strike prices, but all having the same expiration date. The goal of this setup is to profit from minimal movement in the price of the underlying asset, typically a stock or an index. By establishing this strategy, traders essentially bet that the asset price will remain within a certain range until the options expire. The strategy is initiated by selling an out-of-the-money call and an out-of-the-money put, while simultaneously buying a deeper out-of-the-money call and a deeper out-of-the-money put. These purchased options act as a hedge against potential extreme price movements, thereby limiting the maximum loss a trader might face. The difference in the strike prices of these options defines the range within which the trader ideally wants the asset price to remain. The Iron Condor's appeal lies in its ability to generate income through the premiums collected from selling the options. The key is to carefully select the strike prices and expiration dates based on an analysis of market conditions and volatility expectations. To effectively utilize the Iron Condor strategy, a trader must first determine the trading range within which the underlying asset is expected to remain. This involves evaluating market trends, volatility levels, and historical price movements. Once the anticipated range is established, the trader can then proceed to create the Iron Condor by selecting appropriate strike prices for the options involved. The Iron Condor is set up by selling 1 call option and 1 put option at strike prices that bracket the expected range of the asset's price. These are the options that will generate the premium income. To protect against adverse price movements, the trader buys an additional call option with a higher strike price and a put option with a lower strike price. This setup limits the potential losses should the asset price move significantly outside the expected range. The profit from an Iron Condor is maximized when the asset price remains between the strike prices of the sold call and put options by expiration. To manage an Iron Condor effectively, traders often adjust the strategy as market conditions evolve. One of the primary attractions of the Iron Condor strategy is its potential to generate consistent monthly income. This approach appeals to traders who prefer stability and predictability in their trading activities. By selling options, traders collect premiums up front, which can be viewed as an income stream. As each month progresses and options approach expiration, the value of these options diminishes, benefiting the seller. To establish a monthly income using Iron Condors, traders select options with monthly expirations, aligning their trading strategy with their income goals. This requires careful planning and timing, as selecting the right strike prices and expiration dates is critical to the strategy's success. Ideally, traders aim for a range where the underlying asset is unlikely to breach, maximizing the probability of the options expiring worthless. The key to successful income generation with Iron Condors lies in consistency and discipline. Traders must be diligent in monitoring market conditions and adjusting their positions as needed. By maintaining a disciplined approach, traders can increase their chances of accumulating steady income over time. Calculating potential gains from an Iron Condor strategy requires understanding the relationship between the premiums received and the capital at risk. When setting up an Iron Condor, a trader earns the net credit from selling the call and put options. This net credit represents the maximum profit potential if the underlying asset remains within the targeted price range until expiration. To determine potential gains, traders must first calculate the total premium collected. This involves adding the premiums received from selling the call and put options and subtracting the cost of buying the corresponding protective options. This net premium is the amount a trader stands to gain if the market behaves as anticipated. The profitability of an Iron Condor also depends on the width of the spread between the strike prices. A wider spread can potentially offer higher gains but comes with increased risk. Conversely, a narrower spread limits potential profits but reduces risk exposure. Traders must carefully balance these factors when structuring their Iron Condors to align with their risk tolerance and income goals. Iron Condors, while offering enticing income potential, carry inherent risks that traders must acknowledge and manage. One of the most significant risks is the possibility of the underlying asset moving beyond the established range, leading to potential losses. This can occur due to unexpected market events, increased volatility, or a general trend in the asset's price. To identify these risks, traders must continuously monitor the market environment and adjust their strategies accordingly. This involves keeping an eye on volatility levels, economic indicators, and any news that could impact the underlying asset's price. By staying informed and proactive, traders can mitigate some of the risks associated with trading Iron Condors. Another risk factor is the impact of time decay, which can work both for and against the trader. While time decay benefits the seller by eroding the premium of the options, it can also lead to losses if the market moves unfavorably against the position before expiration. This highlights the importance of timing and selecting appropriate expirations in the Iron Condor setup. Proper risk assessment and management are crucial components of a successful Iron Condor strategy. Effective risk management is vital when trading Iron Condors, as it helps protect against potential losses and enhances the strategy's profitability. One of the primary risk management techniques is the use of stop-loss orders or alerts to automatically close or adjust positions when the underlying asset's price approaches the outer strike prices. This ensures that losses are capped at a manageable level. Another approach is position sizing, where traders determine the appropriate number of contracts to trade based on their risk tolerance and account size. By limiting the number of contracts, traders can manage their exposure to risk and prevent significant losses that could adversely impact their trading capital. Adjusting or rolling positions is another strategy that traders use to manage risk in Iron Condors. If the market moves against the position, traders can roll the options to a different expiration date or strike price, potentially improving their chances of profitability. This flexibility allows traders to adapt to changing market conditions while maintaining the integrity of the strategy. Lastly, diversification can play a role in managing risk. By trading Iron Condors on multiple underlying assets or indices, traders can spread their risk across different market sectors. Let's explore an Iron Condor strategy using the S&P 500. The trader expects the S&P 500 to stay between 4,200 and 4,400. They sell a 4,250 call and 4,350 put, and buy a 4,200 put and 4,400 call. The trader collects premiums, resulting in a net credit. This net credit is the maximum profit if the index stays within range. If the index moves beyond, the purchased options limit the loss. In conclusion, mastering the Iron Condor strategy can be a rewarding endeavor for traders seeking to generate consistent monthly income in a market that exhibits limited price movement. By strategically selling and buying options, traders can capitalize on time decay and collect premiums, potentially leading to attractive returns. However, success with Iron Condors requires a thorough understanding of options, market analysis, and effective risk management. The benefits of trading Iron Condors include the ability to profit from stable market conditions and the flexibility to adjust positions in response to changing dynamics. When executed with discipline and precision, this strategy offers a pathway to achieving financial goals and diversifying a trading portfolio. Nonetheless, the risks associated with Iron Condors should not be underestimated. Market volatility, unexpected price movements, and liquidity challenges can impact the profitability of this strategy. By balancing the benefits and risks, traders can harness the potential of this strategy to enhance their trading success and achieve their financial objectives.